Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to show you a simple option strategy that can be used if you're trading with a small account. This option strategy are going to answer the two most important questions. How can I invest for the long term? But most importantly, how can I use those investments in order to get short-term returns? So, if you're new to options or you're trying to use options in order to gauge your 9 to 5 and make extra money, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's option strategy, we're going to be delving into investing and trading all at the same time. There is no reason why you have to choose one or the other. So today, we're going to do both. For today's video, we're going to use Micron technology, ticker MU. You guys know how we like to do it. We're going to go ahead and get down and dirty with options. Remember, the only way for you to learn options is to get down and dirty with options. No matter how many videos you've seen, no matter how many books you've read, you gotta practice, practice, practice. That being said, let's go ahead and we're going to open up the option chain by going to trade MU options to the bottom. Okay, now here we are on the option chain, and once again, the option chain is this right here. What this does is it gives you enough information in order for you to make an informed decision. Now, for today's option strategy, we're going to go ahead and we're going to select buy and we're going to select all. Now, the most important aspect of this option strategy is your strike date. So for the strike date, we're going to go out and we're going to choose a strike date all the way out. For today's video, I'm going to be going with the January 16, 2026. As you can see here, this is going to give us 359 days before expiration. We're going to refer to this again further along in the video. So now that we have buy and we have call and we have chosen our expiration date, so this option strategy is going to work if you choose any strike date, 6 months and beyond. So you don't necessarily have to go out for almost a year. So now we're going to go ahead and choose our strike price in order to do this option. So we're going to choose our strike price below the current share price. And I will be going with the strike price of $90. Now, the reason I'm going to be choosing the $90 strike price is because I like the delta that I'm being offered. I will explain the delta to you in just a second. So along with the $90 strike price and a 0.76 delta, we're going to have to pay $32.20. Now, $32.20 in the real world is going to work out to be $3,220. The reason for that is because each option contract is multiplied by 100 shares. So $32.20 multiplied by 100 is going to give you $3,220. Now, let's go ahead and select it. And this option strategy is none other than the long call or a LEAPS option strategy. LEAPS is an acronym that stands for Long-Term Equity Anticipation Securities. LEAPS option has been getting people wealthy for years now, and you can use it too. Now I'm going to go ahead and show you why this option strategy is so perfect for if you're trading with a small account. So at current, Micron is actually trading for $106.30. If you were to pick up 100 shares of Micron right now, in order for you to use as options, you're going to have to pay $10,630, which is a bit of a stretch for having a small account. However, with the LEAPS option strategy, you're now going to be able to control 100 shares for a lot less, which is going to be the 3,000 down here, which represents only a third of the price. So if you're trading with a small account, it's a lot easier for you to afford to control 100 shares with around $3,000 than for you to buy 100 shares outright with around $10,000. Now, the delta. The delta is extremely important when doing this option strategy. The reason for that is that the delta gives you an indication of how the stock price is going to move up or downwards. So let me break it down. If the share price right here is going to move up by $1, then your overall option right here is going to move up by $76. Once again, each option contract is multiplied by 100. So 0.76 multiplied by 100 is going to give you $76. Now, there are other factors involved, but we're going to keep this video as simple as possible. So if the share price goes to 107, then your overall option is going to go up to 0.76. Now, the stock market does go up as well as it goes down. So in reverse, if the share price drops from 106 to 105, then your overall option is going to go down by $76 as well. Now, why would you do this option strategy? Why would you do a LEAPS option strategy? Well, the number one reason is for you to be able to control 100 shares for much less of the price. The number two reason is because of stock appreciation. The market goes up over time. By buying a LEAPS option strategy, you have given yourself more than enough time in order for the share price to go up over the couple months coming. So if you were to purchase a LEAPS option strategy, all you have to do after that is nothing. And your option most likely is going to go up. Now, another key factor in order for you to use this option strategy is to choose the right stock. Now, Micron is part of the S&P 500, so this stock is pretty decent. If you choose the wrong stock, then this trade could definitely go against you, so keep that in mind. Now, this is an investing strategy. The reason why it's an investing strategy is because you buy a call and now you're waiting for almost a year while the stock appreciates and your overall option goes up in value. At any point in time, you're welcome to close this option strategy and pocket your returns, and that is it. However, we're going to be doing a trading strategy that combines this investing strategy. So with this investing strategy, you're going to be making money over time. Now I'm going to show you how to make money on a consistent basis while you're waiting for the stock to appreciate. So now we're going to go ahead and we're going to switch over the strategy. We're going to go now to sell and call. In this instance, we're going to choose our strike date a lot closer. So we're going to be going with January 31st, and that's going to give us 9 days to expiration. We're not going to do the 24th because there's only 2 days left. So let's go ahead, January 31st. Now for this option strategy, as opposed to the last one, we're now going to go ahead and choose our strike price above the current share price. Remember the last strategy, we chose it below. Now we're going to be going above. Now let's go ahead and select our strike price. Now the strike price I'm going to be going with is going to be dependent on the chance of profitability. So I will be going with the 121 strike price. The reason I'm going with the 121 strike price is because you own a LEAPS option and your primary goal is to make sure this LEAPS option go up in value. Your secondary objective is for you to use this LEAPS option in order to make consistent income. So in order for you to try your best to keep the LEAPS in your portfolio, you need to increase your chance of profitability to meet your second agenda. So that's why we're going to be going for a super high chance of profitability of 91%. Now, with the 121 price and the 91% chance of profitability, we will be paid 0.24 or $24. Now, this secondary strategy is known as the covered call option strategy. You can now do covered calls on a weekly basis in order for you to collect premium while you wait for the stock to appreciate. Now, with the LEAPS option strategy, there is some point in time where the market could completely go haywire and break through your chance of profitability of 91%. That does happen. The market is unpredictable sometimes. However, if that does happen, then you're going to be winning twice. This is one option strategy that's known as a win-win option strategy. So if it does break your 91% chance of profitability and goes past the $121 mark, then your LEAPS would be up in value. Means you're going to be profiting very, very big. You bought the LEAPS option when the share price was around 106, and then you're going to get rid of it. You're going to be assigned, meaning you're going to be forced to sell your LEAPS when the price is like 121. Now, the difference between 121 and 106, that's going to be your stock appreciation. So your stock appreciation is going to be $15. Once again, we're going to multiply that $15 by 100 shares. So your net increase is going to be $1,500. Now you're going to take your $1,500 and you're going to multiply it by, remember, we mentioned it earlier, which is going to be your delta. So if you multiply that by your delta, you're now going to see a net gain of about $1,140. This is why this is a win-win option strategy. So if you lose the trade and you are assigned, you're going to benefit based off of the stock appreciation. Also, while you're waiting for the stock to appreciate, you could make consistent income by selling covered calls. And these two things allow you to grow a small accounts portfolio. This is why the LEAPS option strategy has been making people wealthy from since the beginning of time. And if you know how to use it and use it on the correct stocks, I don't see any reason why you cannot capitalize on this option strategy using a small portfolio in order for you to grow it fast, safe, and consistent. Now, thanks for watching the video. If you have any questions concerning the LEAPS option strategy, please let me know in the comments below. Like the video, subscribe to the channel. But most importantly, if there's anyone out there that's struggling to grow a small portfolio, feel free to share the video with them. Let's help as many as we can. And until the next video, pushing your investments.